Would you trade $120,000 for over $1 million tax-free? Personally, I would. Here's an example of someone who is putting $1,000 a month into a max-funded index universal life insurance policy for 10 years. So $12,000 a year for 10 years for a total of $120,000 into this account. So he's put that in at 32 years old. At 68, he's now retired. And look at this. He can take out over $58,000 a year tax-free for a total of $1.1 million. Over $1.1 million tax-free. Where else can you do this? Now, the benefit of this is that when these amounts are being taken out, they're being taken out through policy loans, life insurance policy loans that do not have to be paid back, by the way. They can be paid back, but if you're going to use this for supplementary retirement, the plan is not to pay it back. So this $58,304, you get to keep every single dime. You don't need to pay taxes to Uncle Sam. And the reason that this grows to this amount with only having started out with $120,000 is because your account is compounding interest. No matter how much money you take out through policy loans, the original amount of your account balance is still compounding interest as if you never took that money out, which is this column over here, this account value column. So even though you're taking out $58,000 a year, you see how this is not going down, it's still going up as if you never took the money out. When you're compounding interest on these figures every year, that is a lot of money. And this illustration is done at 5.99%. Nothing crazy, nothing crazy. So I don't know. I think that this can be a much better option for retirement savings because you are not exposed to the stock market. You never have to worry about market downturns, making up for losses. And compared to pre-tax retirement accounts, these withdrawals are tax-free. It's not income because it's a loan between you and the insurance company. So nobody knows about it except you and the insurance company. It's not income, so it does not show on your taxes. So how can we compare that to a regular IRA? So this is a tax-deferred account. This particular example is $10,000 a year, not $12,000. And this is illustrated at 8%, not 5.99. So after 30 years, not the 36 years in my example, this account grew to $1,132,832 before taxes. Total deferred taxes is $66,000 over the 30 years this person contributed to that account. So here, this little green slice of the pie, this is the $66,000 that they saved in taxes by using a pre-tax account. However, now that the account has become so large and now you're going to start taking out income for your retirement, you have to pay taxes on that money because you didn't pay taxes when you put it in. So at $72,514 a year, still in the same 22% bracket, you have to pay almost $16,000 in taxes, which nets you roughly $56,000 and change a year. Total taxes paid over 25 years, almost $400,000 in taxes. Why? Because you decided to what we call pay taxes on the harvest and not the seed. The seed being the money that you put into the account in the first place, and the harvest being that it grew over 30 years from your contributions and the growth, and now you have to pay taxes on a much larger number than the number that you were putting in over those 30 years. So some people think that these are great plans, and they do have a purpose, but I'm all about diversification, and I think that to be financially secure in our retirement, we need to make sure we have some